everyone, welcome back to Black Wall Street Trading. And tonight we're going to talk about the butterfly spread. And this video is primarily for all my videos are for beginners, people who want to get into trading options. It really made a difference in my life. So I want to share that with everyone else. And so I decided to start showing some of the techniques that I use when I'm trading options. And these techniques come in very handy for people who have accounts that's less than $2,000, $5,000, or $6,000, or if they haven't, which means more than likely they're not trading on margin or leverage. And that's what motivated me to make this video tonight. But before we get started the video, I would really appreciate it if you would like and subscribe to the channel. Help me build this channel there. If you like the content, please hit like and help me get more people. Also, there's going to be some links in the description to Webull. You can actually get 2 free stocks valued up to $1,600. I'm going to leave a link in the description for TD Ameritrade. They don't have a free stock program, but TD Ameritrade is a very good broker. I'm also going to leave a link in the description to Robinhood, which is the platform that I primarily trade on. I do trade across multiple platforms. However, I am going to leave a link in the description. I mean, even if you don't plan on trading, you get, imagine that you open up the account with $100, you fund it with $100 in Webull or either Robinhood, and they give you a stock. What if the stock is worth $2,000? I mean, you don't know. Or if it's $1,600, if it's Webull, you never know. It could be your lucky day. So those links will be in the description once I upload the video. And with that being said, all right, let's get started with the video. So the strategy that we're going to be looking at is the butterfly spread option from the long call version of that. There are a lot of different types of butterflies. There's the iron butterfly, Christmas tree butterfly. There's directional butterflies. I love the butterfly spread. The butterfly spread has given me an opportunity to earn a very nice monthly income. There's still some things that I'm learning every day about this, but I'm not going to talk about that in this video because that was something that just happened. But I was able to adjust, and it gets really complicated, but I was able to adjust and profit from the position by implementing a strategy along with the butterfly. But we're not going to talk about that. So what is a long butterfly spread option? So a long butterfly spread option, it's where, besides from this book definition, I'm just going to give it to you. It's where you're buying one long option, you're buying one long, 2 at the money, and then another one long. And they need to be equal distance apart. And once you set that up, it looks something like this. Okay. So this profit pyramid is what I like to call it. Right here, if you look in the center, this is your landing zone. X marks the spot. This is where, nearing expiration, 4 or 5 days out, or the day of, you want your position to be trading right in here, because this is your green profit zone. Out here, you're losing money, and out here, you're losing money if the price moves shifts outside of your longer legs. In this example right here, you can see at the money is $100. And when I say equal distance apart, if you look on the lower end, there is 5 distance from 100 at 95 at a strike price of 95. And if you look in the higher position, it's 105, which is also 5 positions from the strike price. Now, when can you use this? You can use the butterfly, which makes it so great for people who don't really understand technical analysis. They can't really read the charts, or they're not really sure what they're looking at. They understand it a little bit, but they really don't know what they're looking at. It works in all types of market conditions. The stock can be trading sideways. It can be in an uptrend, like in picture A over here. This would be an uptrend. Here you are, your level of support is actually trending up, where you have higher highs and higher lows. And then it can also be in a bearish market, okay, when you're lower, you having lower lows and lower highs, and you're in a downtrend where your support line is now going downward, and your level of your line of resistance, which would be your top line, is also headed in the downward direction. Okay, so either way, or if it's consolidating, which means it's not going up, it's not going down, it's just basically trading sideways, you can use it in that particular market situation. So in the next slide, what we're going to do is I'm going to actually pull up this option chain, and this is an option chain from inside my Robinhood account. The stock that I'm using and I like to use is the PowerShares QQQ Russell 2000. I liked it. That's not the Russell 2000, but PowerShares QQQ. So right now it's at 345, because this is, I just did the screen capture. So it is trading at 345 at the time of this video, and at the time that I took the screenshot. Okay, so in the option chain right here, if you'll look, I did not capture the strike price above, and I do apologize, but I'll write it in. So the strike price on the higher end of the at the money. So this is at the money. This is your center line. Okay. So you have a center line strike you're purchasing at two times, and you're going to go long. You're going to skip the 346 strike, skip it. Okay. And you're going to go to the 347 strike. And same on below, you're going to skip the 344. You're going to skip this one, and you're going to buy the 343 strike. And that's going to produce this picture right here. If you're trading on Robinhood and this is not what you see, then you did something wrong. Now, if you are trading on Robinhood, and I should have done this in the video, but we'll sometimes when I go live, if you follow me and you subscribe to the channel and I go live on YouTube and I'm trading live, you can watch me do it. Up here in the top where it says custom, you want to click on this, and it's going to give you an opportunity to set your ratios in. The top bar will say normal ratios, and then the bottom bar will say custom. And what you want to do is go to the bottom bar and custom, and you're going to see 111, and it's going to say sell, buy. So in the sales slot, you're going to change the 1 to a 2, and then you'll get this picture right here. Okay. Now let's examine the picture a little bit closer. So over here, the max cost. So if I had an account and I only had $1,000, or if I only had $200 or $300, I could put this trade on. So for every contract up here that we put on, it's going to cost you $55 right here, and your max profit is $145, and the most you can lose is $55. So it gives you a very beautiful it gives you a very beautiful profit loss ratio with this position. So you're either going to win nicely, or you're only going to experience minimal loss, and it gets magnified later on. We're going to look at that in the next picture. So if we were to put on 12 contracts, the most we could lose is $660, but our max profit is $1,740. So $1,740. Now I want you to focus on something. I want you to look at something. You see where this current price is now, where it's trading at, right here in the butterfly as I set it up. Right now, my expected profit would be my expected P&L would be $898 at the 345. Okay. So as it gets closer to the center line, right here, right there, then we get closer to $1,740. Now, is it a high chance that you're going to make that? No, but it's a high chance you're going to make somewhere between there. That's why I love this butterfly. Minimal loss. The most you can lose is $660, but you stand to gain $1,740. That is, so let's say that this person it closed at 345 and we closed it out at 300 we closed it out at, and it was trading at $345, and we picked up $898, and we had a $1,600 account. We had $1,600 starting with, and then we picked up an additional $898. So now you have an account that has $24.98 in it. So as you can see, this is just from doing one, this is one lot meaning 10 or better of using the butterfly of contracts, using the butterfly spread and one 30-day period. So in that 30-day period, you are collecting around $890+. That makes this great. That's why I really like this strategy. Now, how do we achieve that? Well, there are three main factors that and if you see the sign behind me, this is the theta symbol. There's three main variables that we must control for and we must pay attention to. One is choosing the right strike price. Remember, I told you, you want to get your long positions determined. Is your width of your butterfly, they're your protection, okay? And also they put you in the target. So if you're not in the target margin from the beginning, you're choosing the wrong strike prices, and you could lose money. That's when a lot of things come into play. So why should you choose the right strike price? So I can tell you all the risks. If you choose the wrong strike price because you just watched what I did in the video, but you didn't really listen to what I was trying to tell you in the video, and you chose the wrong strike price. Okay, so, and what happens is the stock starts to trade way above your entire spread position. You could be assigned on your long leg, and you have to be mindful of that. Now, what happens if you're assigned? Okay, well, you at that point, you're going to exercise your shorts. You're going to exercise your position and let Robinhood is going to do it for you. But you'd have to exercise your options and try to cancel everything out. But there is one problem. We'll get into that in here in just a second. I'm not going to talk about it right now because I want you to understand you just need to choose the right strike price. If you want to make money on this, you need to choose the right strike price. The ways that you can do that is by figuring out how much that stock is going to normally trade in a year. And I gave you the formula for that. You just multiply the current implied volatility times the current trading price. And then the number you get from there, you add it to the current trading price. That's what it's trading at in a year. And then you subtract it from the trading price. And that's the lowest it's trading. That's going to give you an idea about where you should choose your strike prices. Not only that, you need to go to your technical analysis. Pull up your technical analysis, and if you really can't read the chart, look at look on the week. What has it been doing for the week? Then look and see what it's been doing for the month. And that's going to give you a strong indicator as to where you should place your strike prices. Now, I'm not going to get into the Fibonacci method or anything like that because I'm not a Fibonacci trader. I do understand how to read the Fibonacci and how to use it in options trading. I just don't use it. Some people do, good for them. I do it exactly how I just told you, okay? By determining what the implied volatility is, adding the price for the year, subtracting it, and then seeing what's going on. And then you need to do your fundamental analysis and find out, is there anything that's going on that's going to affect this price shift where the implied volatility could ramp up on me and cause me to be out of position. The next thing is going out far enough for theta decay. So you want to go out at least 14 days, max 45 days, but the sweet spot is 30. 30 days is the sweet spot, and I'm going to show you here on the theta decay chart in just a second. So, and the next thing you want to talk about, you want to pay attention to, is the implied volatility. Now, let me explain myself. I said equal to or less than 30%. For this, if you just started trading, this is for you. Implied volatility should be less than, that means the stock is basically trade. It does not have major market shifts up or down. That's going to be your QQQs. It used to be Apple. I'm not going to say, because right now I'm bullish on Apple. That new iPhone is something else. From what I understand, I read about it in on my Wall Street Journal online version, and it's got a lot of great. It's catering toward YouTubers, and it's just a really good phone. I've been an Android user for a long time. I might even switch, but that stock went from 125 to 129, 130. And I think approaching, as we approach September, I think that stock is going to go up more. But anyway, that's besides the point. So you want your implied volatility. And what is implied volatility? Going back to, if you don't understand what that is, go back to the previous video that I just posted where I explain implied volatility. So you know that is, the higher the implied volatility is the more you experience those market fluctuations. The more you experience those market fluctuations. Back when AMC was really, really moving, the implied volatility was over 1,000%. Now I'm fixing to contradict myself. That's for if you're new. If you've been doing this for a while, you can read the technicals. You want a higher implied volatility. You want a higher implied volatility so you can take a bullish or a bearish approach to setting up the butterfly, because you can do directional butterflies. And that's why I said I wasn't going to get really into that, because setting up a directional trade, and you're a beginner, you probably don't need to do that. This is nice and safe and keeps everything. There's risk assigned to everything. Every aspect of trading can be risky, but this is by far is not as risky as some other, is you buying a call or buying a put. And like I said, that's another video. But the implied volatility. Okay, so when you're trading options, you need to understand how the value of an option. Okay, so let's talk about what is affected most by theta. Okay, extrinsic value is what is affected by theta. So extrinsic value is the difference between the market price of an option, also known as the premium, what you paid. So those positions that you're long, you bought those premiums. Now, listen, it's the difference between the premium and the intrinsic price. Okay, which the intrinsic price is the difference between an option strike price and the current underlying asset price. So what is it trading at now? And the price difference between that is your intrinsic value. The intrinsic value, the extrinsic. So this option is going to lose extrinsic value, everything else, as you get closer to expiration. And remember, the underlying asset, you have to multiply by 100, because the underlying asset consists of 100 shares of that asset. Now here, this is a theta time decay chart. So if you go out 120, 90 days, okay, for anyone listening to this video, if you listen to my other videos, you're probably interested in earning an income, a monthly income. I know you see videos out here. You can get a small weekly income. You can actually get a nice weekly income selling options. Okay, but that's a different type, which that's mainly going to come from your cash secured puts, your covered call options, your leaps, your credit spreads, your put credit spreads, your call credit spreads. those will allow you, and they can also be used to hedge options positions. And I'll make a whole video about that. Maybe my next video will be about hedging your position, because it's actually what I did earlier in one of my trades. But what I want you to focus on right here is, remember when I said that 30 was the sweet spot? So if you look right here, so this is where at 120 days, there's not any effect on this. Look at this. Right here, theta is not affected. Now it's starting to come, it's starting to 90 days out, it's starting to make a difference. 60 days out, 30 days, 30, right? When you get to 30 days, boom, right here at 30 days, if you'll look, it is a big drop off at 30 days, and then it just comes on down to zero. So it's not going out here, going out here, going out here. No, it ramps up and boom. And it's expiring worthless at expiration. So at 30 days, that's why I say like 45 days. So somewhere between 30 and 60, which let's say 45, right about here, you can start to feel, you can start to see the theta. And at that point, whatever your implied, whatever your theta is, that's how much money, if your theta is 1.82, then that's you're basically getting $182 each day that it is expiring, reaching toward as it reaches expiration. Okay, so choosing the right strike price, what is your implied volatility, and theta time decay, those are the three main variables that's going to affect whether or not you're profitable using this particular option strategy. So hedging position, I'm going to talk just a little bit about it. First, I'm going to give you the definition on what hedging is. All right, so it's a strategy used by investors to reduce or eliminate the risk of holding one investment position by taking on another investment position. So although options are used to hedge the market positions on stocks, we can also hedge our position on options with a different strategy, like a credit, such as a credit spread. And the reason I wanted to show you this, because if we go back to our previous slide over here, and the most we could lose was $660, right? Because that's how much it costs us to put on 12 contracts using the butterfly strategy. But what if, I'm just saying, what if you did now a credit spread is exactly what that is? Because if you were doing a call credit spread, meaning you are bearish on this, meaning when I say bearish on this position, you believe that it's not going to drop. The price is not going to, the price is not going to go above, it's not going to drop below a certain number. Like it's just not going to go down. So you're bearish on that position. So you might put on a credit spread, or you might be bullish on one. You might be bullish on it and believing, meaning that you believe that this stock will not drop. It's not going to go below a certain price at all, period, because it's going to go higher. So you're going to put on a put credit spread or a bull put spread, whatever you want to call it. All right. So that's one way. So if we put on a bull put spread, let's say we did that. We believe that this stock is just going to go on up. It's not going to go down. So we place our spread above the at the money strikes. We're going to place it 2 or 3 positions below. But the point is that when you're going to buy low, you're going to sell high, buy lower, which creates a credit. Okay. And when you create that credit, you get the credit, you get it. So if you created a credit that was $280 by hedging the position with one, $280. And let's say you did 2 of those. $560. This is money that you put in your pocket right now. So theoretically, the most you can lose on this other position is $160. Actually, $100 is $160. That's the most you can lose. Why? Because over here, you used a different option strategy. You used a credit spread in which you collected, you did two of them. So you collected $560 in premium instantly. And now the most you can lose over this whole situation once everything is closed out is $100. But you stand to gain $1,740 plus the $560 that you already have. So you stand to gain $2,300, $2,300 versus a loss of $100. I love options. I love options. And if you stay with me, you follow the channel, you're going to love options too. So before I close out the video, let's recap. Choose a stock that historically doesn't experience major market change. Look for implied volatility to be less than or equal to 30%. You should go at least 14 days out until expiration, up to 45 days. However, 30 days is the sweet spot. This is a great way for a small account to build, create a monthly income, and start to experience freedom. And I say monthly income because I told you 30 days out right here is the sweet spot. I totally messed that up. That's okay. 30 days out is the sweet spot. So if you were looking to do these as a way to earn income, then you could go, if you had a $1,600 account, you saw how much it costs to put on 12. You could go and put 1660 up and do you 12 in order to get back $800 or $1,700. We don't know, but we're going to be optimistic. Okay. But you could also put on some other spreads while you're doing this. So it's just so flexible. Options are so flexible. I love them. But hopefully by now you can see the bigger picture as to how you can actually generate income monthly using options to do this. All right. So it's been great. Please subscribe to the channel. Thank you so much for watching. And I hope you enjoyed the video. Make sure you go to the description, click like, subscribe, and I'm out of here. Bye.
On track, now we gon' way up. Don't be used as easy as a layup. Working late.